Hello, this is Steve Cinelli, and I'm the host of the inaugural show of the Crowd Caucus. This is a roundtable discussion of a number of thought leaders in the crowd space. We'll be discussing news, events, trends, and forecasts in the crowdfunding community and in the space. I'm pleased to introduce some of my guests this morning or this evening, depending on where you're situated. I've got Jonathan Frutkin from CROWDFUNDING. Good morning, Jonathan.
Good morning, Steve.
I've got Barry James all the way from London with the Crowdfund Center. Barry, how are you? Barry, can you hear me? I think we're having a little technical difficulties with Barry. And
I'm good, thank you.
oh, there you go. Thank you. Welcome. And then lastly,
I'm here. I'm hoping you can hear me now.
Yes, I can. Thank you. And then we have the publisher of the quotidian Crowdfund Beat, Sydney Armani. Welcome, Sydney.
Thank you, Steve. Good to be here.
As a little bit of a start, again, this is a new program. Hopefully we'll capture some attention of those that are passionate about the crowd space. But as a kickoff, Sydney, maybe you can give our audience a little snippet of some of the current events, some of the current news in the crowdfunding space.
Well, glad to, Steve. Thanks. Well, first, thanks again for inviting me to your program. I'm looking forward to it. You asked us to tell us the news, what is happening, and glad to join your great guest, Barry and Jonathan. You know, they're great in the industry, been in one of the pioneers actually for information. We have a lot of articles of you as well as Jonathan and Barry at the Crowdfund Beat. And, you know, so I started with the news this past week that the big news was the fundraise got $31 million. I mean, and that's a lot of, you know, enchilada with a lot of money in news. And they put it again in real estate. Real estate has been very hot the past months. The real estate mogul about a month before it got $9 million. And so I think you know, and Barry can tell more about what's happened in England. It looks like worldwide we see the crowdfunding real estate has been good. So this is one of the news, $31 million. And the other news is that a couple of articles that, you know, Odyssey Airlines is launching public U.S. crowdfunding. The airlines are getting to this crowdfunding. So it's a lot happening. A lot of new players are coming to the market. And Start Citizen is one of the crowdfunding games. I mean, they raised already almost $44 million. So it's a lot of millions, a lot of peer-to-peer. It's been a very good, positive week last week.
Yeah, and in fact, I think our crowd over in Israel just raised $25 million in a B round. So, yeah, I'll echo your view and your perspective that capital is finding a home within a lot of these crowdfunding platforms. That being said, Barry, you just released a superb research piece on the state of the, as you call it, the e-funding industry. And maybe you can share a couple of the findings, particularly those that actually surprised you. Barry, can you hear me?
Yeah, sure. Yeah, very happy to. Yeah, very happy to. The report called Funding and the State of the Crowdfunding Nation. And as you know, we've analysed thousands, in fact tens of thousands, over 75,000 to see what's happening. And the first surprise is, well, there's no surprise that crowdfund's growing. Everyone kind of knows that, but how and how fast. And we kind of looked at that and we went, how do you capitalize that? How do you capture that? Well, everyone knows how much society and business has been transformed by the computing revolution described by Moore's law, that says that computing power doubles every 2 years, and later on it 18 months. And global crowdfunding, as we've observed over the last 3 months, has grown at a rate consistently doubling every 60 days, which is stunning, and I believe beyond anyone's expectations. So growth rate, rate of sustained growth globally, is the as far as I'm concerned. So that was one surprising thing. I guess the other couple of surprising things. One was the variability. You know, the performance in some categories on some platforms is absolutely anything up to 70% success rates, and in other categories on other platforms, you know, almost zero. You know, 2, 3, 4%. So huge amount of variability, which was slightly surprising. And then, kind of from a UK point of view, it kind of startled us a little bit. The 80%, or very nearly 80% of crowdfunding projects in the UK are on platforms outside the UK, principally those in America. Now, a very thriving crowdfunding industry here. We've got, I think it's 97 different crowdfunding platforms here. So that was a surprise for us.
Mm-hmm. I know that you had referenced in your research that you know, the UK is actually growing at a faster clip than the United States. Yeah, what do you think accounts?
Yeah, that's right.
What do you think accounts for the
I think
faster
there's
growth?
2 reasons. Yeah, I 2 reasons. One is crowdfunding's been very much in the news, you know, and start to penetrate into mainstream culture, and I think we're seeing the beginning of that. But also, I think a big chunk of the growth we're seeing here is the growth that's coming from.
Barry, you just muted yourself. Oh, okay.
I think that came from elsewhere. But just to summarise that quickly, I think one is the beginnings of penetration of the mainstream culture. I think the other is the of equity crowdfunding here.
Do you see? I'm curious with the very rapid growth of crowdfunding, and as you mentioned in your research, and there's a number of other research firms that are tracking the same level of growth. And Jonathan, maybe you can chime in here too. Is the growth in crowdfunding, whether it's the perk-based, whether it's security-based, whether it's the peer-to-peer space, is this really a zero-sum game that financing resources are just being redirected into the crowd space from other types of investing activities or practices, or is this a renaissance of new investment activity?
Yeah, it's definitely a little bit of both. I mean, we have, in the U.S., we have an incredible amount of growth in the peer-to-peer space. In the UK, there's a lot more money going into companies, whether it's through debt financing or equity. Part of that's regulatory. But the money itself is expanding, that is going into investment generally. And part of that has to do with improving economies, the lack of return if you put money into, you know, government bonds, other things like that. So, look, investors are trying to find opportunity. What the crowdfunding world has done is begun to expand out that opportunity. And I think that it shouldn't be a surprise that we're seeing this kind of incredible exponential growth. And I don't anticipate that'll slow down. In fact, it'll probably accelerate as the regulatory environment in the U.S. in particular begins to slowly become more favorable for companies raising capital and investors looking to participate.
I'm curious, Jonathan, because of your securities law background. There's been attempts in the public markets, such as the AIM market in London, the TSX up in Toronto, their venture exchange, and now the OTC, the over-the-counter market, has its QB, the venture angle. Why would you sense that crowdfunding is growing as quickly as it is when you do have public framework to raise money in the public markets on a small and venture-backed basis?
Well, I think that most of the activity that you're seeing, and Barry could probably talk more directly to this because of his experience, not just studying it, but particularly in the UK and Europe, is that what you are seeing is basically an opening of the world that angels and venture companies had lived in. Really early stage concept companies and sometimes A rounds. And that's something that we see very infrequently on the publicly traded markets, obviously because of the expense. And so I think that in all practical terms, the money that we are seeing that is going in from crowdfunding is kind of even though they're emerging market companies, is still pre-revenue, or at least early revenue expansion capital, rather than long-term liquidity capital, which you get from the various markets.
Mm-hmm. Well, one of the observations, and I'd be curious as to all you gentlemen's perspective, is the demographics of the investor within the crowd space. And I'm not necessarily focused on the perk-based participants, the patrons as I would call them, but rather those individuals that are deploying investment capital. It would seem, at least by my cursory observation, is that there's been a lot of young, the millennials, the 25 to 34-year-olds who, through their own activities in possibly an early stage company, have had a win or a monetization. And because they recognize the risk and return and thereby receiving the return successfully, they're looking to redeploy as opposed to building a sort of a conventional portfolio, investment portfolio. Could you guys comment on the demographics of the participants in the crowd investing space?
I'll defer to Barry to see if he has any actual data, and then I'll throw in my 2 cents, which is backed up by nothing but my own opinion.
Okay. Let me combine this with the answer to the previous question, if I may, in that I am absolutely 100% clear that we're out of the zero-sum game. If you can look research, not so much ours, but the work last year made this very, very clear that the crowdfunding movement globally has the potential to massively increase the amount of available venture capital. So I'm really clear about that. How we're seeing it happening, well, not so much in the peer-to-peer area, where I think, perhaps most of the new capital, not all of it, but most of the new capital is coming from stuff that would have gone in the bank, savings or whatever, into peer-to-peer. But there's some new as well. But crowdfunding is attracting lots of capital for non-traditional reasons. It is about return on investment, but it's also about other things as well. And I'd even venture to suggest that to kind of understand this phenomenon, you've got to look beyond the capital. Capital is important, but actually you've got to look at the entrepreneur's journey, and you've got to look at the entrepreneur's training, and you've got to look at the opportunities, and you've got to look at the way that this bears on and I don't would like to have. I'm going to do lots more research. We're engaging with some of the universities now on this, on the profile of investors, and and the age profile being one of them. But my feeling is that the millennials, those at the end of the scale, are far more turned on, are far more engaged with crowdfunding propositions, because not just of the transparency, but because there's a spark there, that's about the innovation, that's about sometimes the social agenda as well, and the drive to see something happen and make a change to the world and be part of it, I believe is drawing in new capital.
Mm-hmm. And to that point, in terms of the demographic and the ability to bring in new capital, I know prior to going live on the program, we spoke briefly, and Jonathan, I'd love your view in the potential changes in the accredited investor definition. And what do you see there? What do you see in the future? Will that happen? I know from just the history of the SEC, the establishment of accredited investors, which emanated back in the 33 Act, but it wasn't defined at the time. I think it was considered Rule 127, 129, and it wasn't until 1982 that Regulation D was established with the minimum levels of income and net worth. We played, as you remember, when we launched Off-Road Capital in the late 90s, early 2000s. There was conversation at that time, which was literally 17 to 20 years after the establishment or the definition of Reg D, that they were going to shift upwards the income levels and the net worth levels. The only change, of course, has been the exclusion of one's personal residence, the equity in the personal residence, but for the most part, the numbers and the levels have remained the same. Maybe you could comment on what you see from your vantage point.
Well, I really think that there's been a lot of hand-wringing because Dodd-Frank asked the SEC to look at what an accredited investor is. And just so everybody understands, this is a discussion that's been going on now for a few years, so it's not today. But why it's come up more recently is, of course, we have some groups, including the Angel Capital Association, that are actually being proactive to prevent us from having this catastrophic kind of recalibration in just raising levels of what an accredited investor is. So here's what's going on. I'll go back to Barry, and then we can talk a little bit more about accredited. What's going on is you have older people who are in accredited, angel investing groups, older accredited investors who have both experience and capital to put into a company. And then you have younger people who don't really have access to that. And we'll just call this, especially in Northern California in particular, there's a lot of people with a lot of capital and they want to put it into companies. And the idea that it is available online and they can see things online gives them a comfort level that, quite frankly, an older person wouldn't feel in that circumstance. They like to feel paper. They like to physically meet people. They don't like the idea of hanging out on a Google Hangout. And so you're seeing this age shift. And with that comes this redefinition of accredited. And I think the challenge is going to be for people who believe in the free flow of capital, in people more maybe on this hangout, will be the effort not necessarily to raise the level, but to keep it where it is, but also expand it into professionals who might have some knowledge. David Schweikert, who's a congressman from Arizona and led on the Jobs Act with some of the others, he talks about an investment opportunity with something that maybe a chemical engineer would have great knowledge about, but because their income might be below or their net worth might be below, they couldn't invest, while some person who might be older and living on retirement income who happens to have enough in net worth could invest in something they know nothing about. And so I hope that what comes out of the SEC is some sort of combination of figuring out levels of income and net worth, but also including people who might have particularized knowledge, or a financial advisor or somebody who can direct them. So I don't think it's all bad, but I do think it's all interesting.
I get one of the curiosities is the nature or the subject matter of being an accredited investor somewhat arcane, somewhat anachronistic. The purpose of the accredited status was to enable small businesses without the same level of compliance and regulatory submission to raise capital through those investors who had financial means and could afford the losses. And we continue to try to evolve the 33 Act's definition of accredited. Whereas on the flip side of the equation, and I've been exposed recently to some of the public markets, the pink sheets, the over-the-counter market, where every John Q. public can play in these small, these small incipient companies that have a tremendous amount of risk, may or may not have business models, but the public can invest, their $10, $100, $1,000, and there seems to be somewhat of a bifurcated level of responsibility from the SEC, is that you allow small investors to access small public companies with limited reporting and so on and so forth. But then you have, on the flip side, the whole Reg D, crowdfunding, Title III, creating some obstacles in terms of investors being able to access private, allegedly unregistered securities. But for the most part, the risk profile, and I would submit that in the crowd space, with the practices and the disclosures of many of the platforms are providing in terms of description of companies' financials, being able to engage with principals in these companies, that the private markets actually do a much better job in disclosing information. However, the John Q. publics of the world can't access that. I'd be curious as to your thoughts there.
Well, it's unquestionably silly, right? I mean, and we're definitely nearing the end of this era that somehow we're so afraid that people are going to lose their life savings by investing in private companies. And maybe this is best to throw over to Barry. I mean, I anticipate that as things begin to open up here, you're going to see a lot more people who are investing in deals where they not only know the people, but they've done a lot more research than was possible in 1982, right? And so the links between the people and the companies they're investing in and the amount of research, I think, really makes a lot of this super kind of an anachronism that we're going to see disappear in the next few years. But Barry, do you really see what I suspect, which is people who are investing in equity plays in Europe and UK have some sort of connection personally or through a first level connection to either the founders or the product?
Yeah, absolutely. I see very much that we're on the cusp of a big change here. I think it's become irresistibly clear that we're living in a very different world than the 1930s and 40s, where a lot of these trends, rules, frameworks were created and set, which unintentionally, unintended consequences, have created a kind of financial apartheid, where there's those who can participate and those who can't. That has become very controversial. Our terminology is a little different. Our regulator talks about sophisticated investors. We now live in a world where information flows more freely. Crowdfunding in all its forms, and including equity crowdfunding, isn't a world of disclosure where it's a matter of titrating how much you're going to allow people to know. It's a world of openness, and open by default. And just this week, we've seen what I think is is probably the leap forward on all this. We've been saying for some time that you can't regulate this by tweaking and adapting the framework that's there, because it's so different. Because the hyper-connected world is different. These things were created when there was no such thing as Twitter or Facebook or even the web. And 2 years ago, I wrote an article saying our regulator needed to open an innovation unit to help it understand, to help champion and support innovation. And literally last Thursday, the head of our FCA, our regulator, has announced the opening of an innovation unit. And they're saying in set terms that we now need ways to wrap the regulation around what's happening, rather than try to shoehorn what's happening into the existing regulation. And I think this is a huge leap forward, not just for the UK. I'm hopeful that this will help. We know that our regulator talks to your regulator very regularly, and they coordinate things. So where you are too, and allowing the crowd into equity crowdfunding is a crucial stage. I think it's a very interesting moment in the history of equity crowdfunding.
Barry, I was curious because I'm somewhat familiar with the AIM market. Some of the things that I believe that the UK has done that actually surpass possibly even the United States is within the AIM market, companies that are listed there, there's initial tax relief. There's tax incentives that investors can obtain in terms of limiting, capital gains taxes to the tune, I believe, of close to 30% by investing in companies that are listed on the AIM. There's the enterprise investment schemes that support the formation of capital within the public markets. Do you see the private markets going down the same path in terms of providing tax incentives to investors over and beyond just the pure economic return?
Yeah, it's happening, Steve. It's happening right now. So we're seeing the enterprise investment scheme, which the government has looked at and decided is extremely successful, and they want to continue with that. Very, very generous tax allowances that give you a huge comfort blanket as an investor. And they're now being more and more widely applied, and they're going to be and they're already applicable to a lot of equity crowd funds. So yeah, the EIS experiment, the enterprise investment scheme experiment, has been a big success, and that's one of the things that's is going to help drive this as well.
Steve, I have to jump in here. We're gonna have.
I think you're trying to say something, Sydney. You're muted.
Yeah.
Oops. I can see Sydney chatting, but we can't hear you. Jonathan,
I just wanted to add up here a little bit. That I'm here in Silicon Valley. We see a lot of young, new, rich, young Googles and Tesla, and they're all driving one of those $120,000 Tesla. So it's a new generation of the investors, and it's still maybe the old-fashioned way, but we see that the younger generation with the money, of course, they have no problem to put investment in this company. If anything, E-Trade started here was, and we had an article on crowdfunding about it. It's the same revolution is happening as happened in doing the brokers, and they used to go to the brokers, and you have to meet your brokers and somehow invest in the way to your broker. Now with E-Trade and online and other applications show up, and kind of the brokers at the time, they embrace it. They see it as a financial products, and that's what they see the whole this crowdfunding evolution. It's as it's still the old-fashioned way. You got to go meet people, but it's just another finance software, another financial evolution. That's what it is. Same as was for the brokers.
I guess one last question. I don't know how much time we have remaining here, but
you got a few minutes, but you got to do your weekly peak also. You have a segment in here.
Okay. What from both Jonathan and Barry's standpoint, what do you see in terms of best practices from the platforms that are out there? Obviously, we chatted briefly about the disclosure between public companies and private companies, the fact that the crowd is really taking advantage of social media, the ability to communicate online. One of the things that I reflect upon back in the 2000 timeframes when we launched Off-Road Capital is the conclusion that finance is really an information business. From information is transmitted from user of capital to provider of capital and back and forth. The private placement process, as we've all gone through, was a very analog process. Lots of paper, lots of dialing for dollars. The advent of an application of the internet, the ability to share and extend and distribute information within a structured way enables that flow of information to be done a lot more efficiently, broadly, and so on. Still, the underlying theme is that crowdfunding is certainly a technology application of, as I call it, distributed finance, but you still have a finance responsibility in terms of disclosures, making sure that investors, whether they're receiving information in an online fashion or in a paper fashion, still have adequate information to make informed decisions. What do you see in terms of some of these platforms? What are they doing sort of in a didactic sense to promote good investing practices, good disclosure requirements? Do you guys have any viewpoint on that?
Yeah, sure. I can kick off if you like. It goes back to the point I was making earlier that we're in a new environment here. So and it's as different as being in air and water. It's not a small difference. It's a big difference. We swim in information, and there's a core expectation when someone involves themselves, invests in an equity crowd fund, that it's on the basis of transparency, of ongoing relationship, and of being able to actions at any time, not just as an AGM or whatever. So some of the platforms are better at this, others are less good and getting better. Most of them, hopefully, but continuing that dialogue, so that the conversation doesn't stop when you get funded. It goes on, completely of the essence. And again, I would say to just see this through the lens of the more traditional disclosure model is to miss the point. And the platforms are a key part, if not crucial, that.
Yeah, I would agree. I think the ability to use multimedia as opposed to just flat content enables investors to become more engaged. The ability to drive information in many different forms allows them to comprehend things in a much broader fashion, and hopefully, at least in my view, by being able to read, to listen, to hear, to see, to experience, to have a bilateral communication, through a technology mechanism, should translate, or hopefully will translate, into investors becoming more comprehensive in their reviews, more informed, to where they're making better investment decisions, and hopefully that translates into better investment results. What do you think the next of the platforms out there? And I've sort of started a little research project of my own to compare and contrast, particularly on the equity-based platforms, to see who does what well, who captures the essence of the story, who provides a level of financial acumen and analytical acumen, which they convey to the investors. What are some of the platforms that you gentlemen have seen that would rank sort of top tier?
I'll defer to Barry on the actual question, but I just wanted to highlight something you just said and put it differently. Sure. What you like, Steve, when you're on a platform, what you like is you like stuff that's in English, right? You like videos, you like interaction, you like to know what's going on. And what we've done is we've over-lawyered stuff to death. And I remember when we were doing off-road, we did a dictionary. I don't know if you remember this.
Absolutely, absolutely.
And the off-road dictionary would explain what all this crazy stuff meant, what were drag-along rights or tag-along, and we had kind of a multi-page dictionary. And all this stuff is nonsense, right? Because really what you want to know as an investor is this a good product, and are the people behind it capable and competent to pull it off? And that's all English. That's not lawyer talk. And so we're going to see that, in my view, we're going to see deal terms begin to become more standardized. At the same time, we're going to see disclosures go into English. And that'll take the form of videos and photos, and a lot less in the form of big, thick lawyer documents. And so we could talk, I guess, maybe Barry could identify some of the sites he likes so that the things are in actual English rather than in lawyer.
Yeah.
Barry?
I think Steve's spot on. I think he's exactly right. This is the direction of travel. I guess I'd just highlight 2 or 3 of the platforms for a rather different approach. So I wrote an article recently about the different approach of Crowdcube, the initial innovators who take a direct through approach, if you like, very much crowdfunding as we know it, in terms of the direct relationship between the investor and the investee, the entrepreneurs, and so on. And as an enabler of that, and that contrasts somewhat with seeders who are equally well known, but very much functioning on a hybrid model, where they take and to themselves quite a lot of rights through a nominee structure of the shareholders and intermediate. So they become intermediates again, and that's quite an interesting contrast. Those 2 have grown up in parallel. One very clearly a crowdfunding model, the other one arguably re-intermediating. So what does that mean? And then the third interesting one is Syndicate Room, where we're seeing them and people like Angel's Den, who are trying to hybridize with the angel model. So they will have a lead angel on a deal who will do a lot of due diligence and make that available, putting their own money in and then the crowd can come in on their own terms. It's quite a new thing. We'll see how that goes.
Okay. Steve, if I may jump here, we just had top 15 of platform, actually, you know, the top 15 crowdfunding platform it is in the Crowdfunding Beat UK edition, and along with the Barry's great last articles and he wrote about, and the regulators flip, e-penny drops. What's all about e-penny? What kind of a penny drops, Steve? I mean, Barry. I'm going to ask you a question.
Yeah, this was really referring to, you know, we coin these terms e-funding and e-finance to kind of understand and help us to understand the real impact of crowdfunding and what I call crowdonomics on the way funding works, on the entrepreneur's journey, and in terms of creating this e-funding escalator. And it was a bit of a play on that, really, that the e-penny, you know, it's impossible to say, but interesting to speculate. You know, part, you know, that thinking is now playing in our regulator, and particularly the fact that they've flipped from it's got to fit into this framework to no, we need to understand this and adapt the framework around it.
Yeah. Well, thanks, Steve. Just another in the other articles that we saw that Paul Nader and Alsop in Australia wrote a great article about crowdfunding 2020, and that is in crowdfunding, which is very interesting notion. Say that 2020 we're not even going to talk about. I mean, it's just part of a system. It's just no such a thing as crowdfunding or any kind of. It is just part of a system. So it's very interesting. It's all here, Steve. But we're running out of time a little bit, so we have about 5 more minutes.
Great. I'd like to revert back to the point we were talking about in terms of, Jonathan, you were mentioning we've overly lawyered the private financing process. I would beg to agree with that. But it's not only about the lawyering. It's actually about, and it goes to the points both you and Barry raised, the financial literacy. Is there a responsibility of these platforms to introduce and educate investors in terms of their client companies raising money? Some platforms take a hands-off approach, you know, merely having models, which I would construe as somewhat bulletin boards, sort of, you know, put something up and, you know, everybody can come to the table. Or is there a responsibility to make sure that disclosures are done well and that you educate literally a financially illiterate public, if in fact I could be so, you know, brazen to say that? You know, some of the concerns that I would have is not only covering your, you know, certainly the terminology dictionary that we talked about years ago is one thing, but at the same time the underlying economics. You know, what should there be some level of discipline? Some early stage company is posting on one of the equity-based platforms. They're trying to raise $500,000 at a $50 million pre-money valuation. You know, that becomes challenging. Should there be some level of responsibility from the platforms to say, well, based on pricing, based on structure, based on this is what makes sense for you, the investor, or should it be left to the devices of the company to do what they want, to disclose what they want, to price their issue wherever they, you know, deem appropriate? I'd love your comments there.
I got 3 things on that, so let me do it quickly because I know we're running out of time. The first thing is that I think there's no question you're going to see a lot more you could lose all your money stuff. You know, this is risky and you need to look at several things. So I think we're going to see that in the form of video and other ways that people can learn it. The second is that we're going to see the emergence of kind of an analyst class. And those are people who are not going to be invested in deals, but are more or less what we see as analysts currently, who are looking at these deals and putting in their 2 cents. But the third is, I think that you're going to see very, very few people who end up investing in startup businesses. We've been talking a lot about emerging businesses today, and I want to really briefly explain why. If the four of us had a venture fund and we had $10 million and we put it in 10 deals, and the first 7 tanked, 2 of them broke even, and we got 20 times on the 10th investment, we give each other high fives and do it again. That's what venture funds do. Individuals don't think that way. If you miss 7 times and break even twice and you get 20 times your money on the 10th, all you're thinking is, how darn lucky did I just get? And that is going to really, really get, I think, all this in a way kind of taken care of, which is we're going to see people who are less financially literate, less likely to invest in emerging companies, and more likely to invest in debt or equity in the real estate space, other places where there are assets, or community-based businesses where they can see it, or in various other sort of asset classes that are less risky but have less return. And so to go to your point, Steve, I think in the short term, yeah, there'll be more disclosure. In the longer term, kind of won't matter because we're going to chase out a lot of people just because of how investing in emerging companies works.
Yeah, one of the observations I had in the there's an ongoing comparison between the angel, well, I wouldn't say the angel, well, yeah, the angel investor and crowd participating investors with the venture capital community. I think it's somewhat of a misnomer. While capital may be going into the same types of companies seeking, alpha, seeking, above market returns, the business models are completely different. As you suggested, Jonathan, if the four of us had a venture capital fund of $10 million and allocated it into 10 different deals, that's one thing. Under the venture model, that $10 million of capital is not our own. It's investors, it's limited partnerships, and we get actually paid to take those risks. We don't share the downside. We do participate in the upside, but we don't share the downside. It's not coming out of our pockets. The investors in the crowd space and angels by and large, they're investing for their own account, and so losses are a bit more severe to deal with because the investor is losing economically for the ones that go sideways or go down. Could you guys comment on the comparison or the views of the sort of the venture capital model and their ability to do certain things that possibly and rightly an angel investor or a crowd participant should not do?
Steve, we have 3 minutes, so time.
Yeah. Can I come in on that?
Sure.
Yeah, 2 things. One is absolutely of the essence, and you put your finger on something really important here, is that in the crowdfunding world, in the crowdfunding chain, down. That's one of the things that contrasts with what's gone on in the last few years and is at the seat of that. But in terms of this different environment, let me just put it this: what we're seeing is if fund goes up with a stupid valuation or something wrong with it, it only takes one member, one intelligent member of the crowd, one informed member of the crowd. So you know what? Let's look at this, and there's a leveling up of awareness, a leveling up of savvy, a leveling up of information as a result of that, because of the openness. That's a huge difference. The regulatory community said, look, in the UK there's 1,000, it was 10,000, 30,000 or whatever it is, people involved in regulation. We don't have nearly as many eyes as the crowd. And what we're finding in practice is that's what's happening, and that's one of the big aspects of this new.
Yeah, so there's almost as if I can paraphrase, sort of a self-policing effect that creates a sort of a salutary effect, a benefit, by having the crowd view, or many in the crowd view from various perspectives, and the collective wisdom, the collective cognition, the decision making. I know that one of the things that's been espoused by many in the crowd arena is the lack of fraud. Certainly, there was this one episode just recently on Kickstarter which received a little bit of profile, but that was sort of the exception to the rule. Uniquely, the crowd space has been somewhat devoid of fraudulent activities, based on what you just articulated, Barry, that there is a self-policing feature.
Steve, if I may jump over here, there was a report actually in Washington that the Washington State, they had some basically some sort of kind of a fraud, and they were looking at it basically. So, but it was about Kickstarter things.
Good. So, should we wrap up here, Sydney?
Yeah, we need to wrap up, and well, let's for audience at home and people watching that the name of the show is Caucus. This is the first one. Usually it's a special, so we had it for 1 hour, but the show it's about 20 minutes, and we have Steve Cinelli and hosting the show, bringing his guests, and Jonathan Frutkin. And Jonathan, thank you for being here. One of the regulars, hopefully you will be one of the regulars in our show, and it's going to be Sunday's show. And Barry, we're always grateful, if you give us news, honored to have you, and give us what's going on in UK. So you will be our London, and great job you do with the crowdfunding center. So and we get prospective not only in UK, other places in the country, European Union. So Steve, yeah, we can wrap it up, and hopefully every Sunday we're going to be promoting the show, and it's for people that they want to know more in depth of the crowdfunding, and I will give you the news.
Well, thank you, Sydney, and my great appreciation to both Barry and Jonathan for launching this inaugural show, and hopefully some good points came up, and we can continue down the path of educating, prognosticating, a number of different things about how this nascent industry is developing at a very rapid pace, and yeah, it will change the capital markets, certainly for the better. So thank you, Sydney, and we'll see you next week.
Thank you.
Okay.
Thanks for inviting me. Thanks a lot. Bye now.